If you want to actually have your credit card application approved over and over and over all the time, you got to pay attention to how you report income on your credit card application. This is really important. The application, there's a section where you have to report your income, and there are a lot of different types of income. So let's just talk about that. Let's have an overview about the whole conversation. So what really counts as income? The whole thing here is that when you talk about a credit card and you have an application, income can be anything. Okay, income can be personal income, your 9 to 5, your gig, your Uber gig, your DoorDash, whatever brings money legally into your household can be considered income. Okay, this is really important. By the way, boss, welcome back to the show. I really appreciate having you here, and we love, just make yourself comfortable. We love having this kind of conversation every now and then. And the thing is, when we talk about personal income, let me just explain more deeply what qualifies as income. So if you are, let's say you are currently age 21 and older, personal income actually encompasses things like your 9 to 5, your regular W-2 job, right? Income from a spouse or partner. So right now, if you're taking care of the kids or you're home and you can't work right now, but your spouse, your significant other has a job, so this could actually qualify as your income. So when you apply for a credit card, you can actually take your husband's or your wife's income as your own. The law allows that, not a problem. If you have allowances and gifts, this could also be income, because let's say you have allowances from your dad or from a grandfather or from an aunt or an uncle, or like anybody in the family, or even a friend. This could be considered income. Okay, you have trust funds distribution. So let's say you have a family member who has set up a trust fund for you, and according to the provisions of the fund, they have to pay you on a monthly basis, let's say $1,000 or $2,000. As long as this is recurring and it is consistent with what's in the contract, then you can consider trust fund distributions as income. Scholarships and grants also. Okay, and retirement fund distributions. So if you are over 65, you're getting some retirement fund distributions. You can count on that as income, and Social Security income also. Now, this was for those who are on age 21 and older. Let's say you are younger. Let's say you are between let's say 18 and 21, or you're even younger. Okay, the thing here is that you can report only independent income. Like, you can't talk about my parents' income. No, it has to be your own income. So on a credit card, if you apply for a credit card in your own name, it doesn't matter if you're still living with your parents. You only count your own income. Because the thing is, if you want your parents to count if you want their parents, your parents, to count their income, you're going to have to be added as an authorized user. In other words, you're not going to be the one applying for the credit card. Your parents should be the one applying for the credit card, and they will add you later on. Once they get approved, they will add you as an authorized user. But if you want to apply independently for your own card, you can only include independent income. In other words, income that is tied to you. Okay, so this could be personal income, including regular allowances. So if your mom or dad are just giving you $500 every month or $1,000 every month, that could be this could be actually considered income. But it has to be documented for the credit card company to actually accept that source of income. It has to be documented, and it has to be consistent. Like, your dad cannot give you like $1,000 this month, and next month he gives you $200, or your mom cannot just give you this month $800, and the following month she gives you $3,000. It has to be consistent. It has to be recurrent. That's the first category. Okay, and then if you have scholarships and grants, this could also qualify for income. By the way, I want to quickly remind you of today's topic, boss. We're talking about how to report income on your credit card application. How do you actually make sure that you are putting numbers where they should be? You are clarifying things for the credit card issuer, so that when they review your application, they can approve you real fast. One thing I want to say here is that it's really important to understand that credit card approval depends on your income, but it also depends on your credit history and your debt to income ratio, which is basically what? Your current debt payments as a percentage of your income. So even if you're making a lot of cash, if your DTI your debt to income ratio is high, you're not going to you may not get approved. So here you have it. Now you understand what counts as income, right? So if you are age 21 and older, you know what counts. If you are under 21, you also know what counts as income. Now let's talk about what doesn't count as income, because this is really important. Because I don't want you to really mention income or numbers that you don't have access to, or numbers that are like just lies. Never lie on a credit card application. Never lie on a loan application. Never lie on any financial any application you actually you file with the financial institution, or with any other institution for that matter. Okay, very important. Never do that. You have all to lose. Now, it's not a good idea to state borrowed money, including student loans, as income. Although there is no specific law against it, such reporting will go against the spirit and intent of the ability to pay clause in the Card Act. Okay, so this is really important, and this could hurt your finances because it's debt. It's not income. Borrowed money is debt. Okay, so it's really a bad idea. So don't really do that. And when the loans come due, paying back the balances on your cards could prove really difficult if you're thinking about your loan, your debt as income. So money. Let me ask you a question, boss. Do you currently have some outstanding loans? Do you currently have like a loan that you took out and the loan is sitting there? The loan is sitting in the bank account. You haven't actually touched it yet. And are you thinking about considering that loan as income? If you're having those thoughts, I want you to really stop that right now. I want you to stop thinking those thoughts, because those are bad thoughts. You should actually get your ass up and actually start looking for a real job and get a job and make real money. Your money. Okay, your money. Do not count on income from a lender as income. That's not even income. Don't count as a loan from a lender as income. Okay, so this is really important. So now you understand. The next time you apply for a credit card, on the form, you know what counts as income, and you know what doesn't. No matter how old you are, you know what counts and what doesn't. Now let's talk about, why do credit card applications inquire about your income? One thing you need to understand here is that credit card issuers are worried about one thing. They want to get paid, right? Because they actually are lending money to you, and they want you to repay them. That's all. They're just trying to cover their ass. So making sure that the person who is going to use the card, that person has the ability, has the financial ability, has the monetary ability to repay whatever that person charges on the card. It's very, very simple. Okay, so credit card issuers ask for your income on your application because they need to be sure you can repay your debt. Okay, while exact approval criteria for credit cards is actually considered proprietary information, they typically look at your income, they look at your credit score and other factors to come up with a general idea of your creditworthiness. So what I'm trying to say here is that simply because you have a bad credit doesn't mean you're automatically disqualified. Like we hear from viewers and some of our clients saying that, hey, listen, I have a crappy credit score. I'm currently around 400. I've been sitting there for the last 2 years, whatever. I'm just desperate. I'm not going to apply for a credit card. But hey, listen, if you're making good money, the great income could be a sort of a mitigating factor. All right. So this is important to think in those terms. So the credit card issuer looks at a constellation of criteria before approving you. It's not just one criterion. Okay, they look at a constellation of criteria. So this is important. And one thing I want to say also is that it's always better, if you want to be approved real fast, no matter what you put on the credit card application, to actually apply at a bank where you currently have an account. If you apply at a bank or credit union where you currently have an account, this is even better. What you do is you want to have direct deposit that comes into that bank so they can see how much you're making. And if you have direct deposit, that will increase your chances of being approved at that specific bank. Okay, because a lot of times bank analyze diversity of income sources to actually come up with like what they call a composite income amount that you're making. Like you could be thinking that that you're making $1,000 a month, but the bank, based on their calculations, thinks that you're making more. And this is better because it is really in your advantage anyway. I want to talk to you about the, the it's really important to understand that when issuers check your income, there are things they're looking for. Okay, there are things they're looking for, but they also look at like they have other ways to check your income. Like you could say, I'm making 20 grand a month, or I'm making 20 grand a year. Okay, that's fine. The credit card issuer, the banks, the credit unions, internally they have models. They have quantitative models whereby they actually evaluate whether or not what you're saying is actually true. This is why earlier I was just talking to you about the fact that if you have direct deposit come into your account, you are basically convincing the lender that, hey, listen, what I'm telling you is just legit. Like, I'm not lying to you, whatever. Everything is legit, and I can prove it. Okay, but if you don't have that, then the credit card issuer is going to look at independent models to actually evaluate whether or not you're telling the truth. So they do income modeling, which is a strategy whereby the credit card issuer actually use like internally, they use some algorithms to see whether or not you, based on your income, based on where you live, okay, you can actually afford, or you can actually first of all, you can afford where you live. And if you afford where you live, how long have you been living there? Now, in other words, they look at independent criteria to sort of ascertain the number you give them. So, for instance, if you're saying, listen, I'm making $100,000 and you live in a multi-million-dollar neighborhood, so that means you're hiding something, right? Especially if you own the house. Or you say, listen, I'm making $25,000, but you live in a neighborhood where the rent is like $200. I'm exaggerating though, but hey, you get the point. The point is that if the credit card issuer sees some discrepancy in your story on your credit card application, this could be grounds for rejection. Okay, and so they use income modeling to actually calculate or evaluate your income. So income modeling means algorithms. Okay, they are produced by credit bureaus to estimate your income based on your credit report information. Besides income modeling, credit card issuers also use financial reviews a lot. Listen, it's not about they not trusting you. They trust you, but they just want to do their own independent review also. By the way, I want to quickly remind you of today's topic. I'm talking to you about how to report income on your credit card application, right? I'm giving you tips and tricks to really put the right numbers where they should be so that you can be approved. That's what I care about anyway. So, besides income modeling, credit card issuers also use financial reviews. Okay, so if you're spending a lot let's say you're spending a lot or applying for several cards within a short time, some creditors will run what's called a financial review to verify your income. And such reviews are expensive for creditors to conduct though, and they tend to be rare. So during such a review, you may be asked to provide tax returns and other documents to verify your income. If you cannot provide proof of your reported income, the creditor may lower your credit limits or close your account. So basically, they are just, again, it's all about them verifying independently your information. So big decision time here, big decision time. Can you currently substantiate your income, boss? Can you currently confirm your income? If yeah, that's fine. If you cannot, then this could be a problem, because if the credit card issuer is asking you, let's say they're asking you to provide your income tax return for the last 2 to 3 years, you got to be in a situation where you're basically showing them the numbers. You're showing them your return, and your return must show the numbers that you're saying on the credit card application. One thing I want to say also here is that you need to understand, when we talk about the credit card issuer asking you for tax returns, it's not just the first 2 pages of your 1040. We're talking about maybe 1,000 pages or the full 100 pages of your tax return. And most people, because they file online, they have no idea. They have no idea what the tax returns really is in terms of how heavy it is. Okay, whether it has 10 pages or 100 pages. It's only when the credit card issuer wants them to provide that data to mail that data to them, that the applicants, the borrower, realizes that, hey, listen, it's huge. Okay, so you really want to be in a situation where you actually check on you have the right financial review. Now, let me just close to this conversation by saying something that is really important. What happens if your estimated income is off? Now, the thing here is that estimating your annual income in good faith and coming up short is completely understandable. As long as this is an honest mistake and that there was no foul play behind that, you should be good to go. Okay, inventing self-employment income, grossly inflating your actual income, or listing a non-existent employer, though, is a different matter entirely. Okay, if a creditor can prove in court that you committed fraud when applying for a certain card, it could make that unable to be discharged in a bankruptcy proceeding. Okay, this is really important to think about that. On very rare occasions, people have been convicted of fraud for lying about their income on credit card applications. Okay, so those people, they have actually faced jail times. Okay, they had like real steep fines. Okay, and one thing I need to say here is that all these things are important, and there is a big but here. Let's say if you've reported your income to the best of your knowledge, don't worry about anything. Okay, because proving fraud is not easy, and a consumer who truthfully list monthly income that happens to be irregular is not going to some close it's not going to some lengths to lie on the credit card application. Okay, those are what we call honest mistakes. If it happens, then the judge will understand that. The thing here is that the best way to actually avoid estimated income that turns out to be off is to actually sit down and have an Excel spreadsheet whereby you just list all your sources of income and you actually filter that Excel spreadsheet, let's say a month over month over month, so you know exactly where you are at in terms of your income, in terms of your liabilities, in terms of everything that you need to have. Okay, that way you can see whether or not your income that you're putting on the credit card application is really off, because you know that some sources of income are just sporadic. They happen maybe 6 months from now or 3 months from now, whatever. Okay, but you want to make sure that you first list the consistent income. You want to list the regular income before listing the irregular income. So it's really important to prioritize the frequency of the income you want to list on your credit card application. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about how to report income on your credit card application. So I explained to you what counts as income, what doesn't count as income. Why do credit card applications inquire about your credit? Okay, and when issuers issue your credit, what happens here, and what happens if this estimated income is off? Thank you so much for your attention. I really appreciate it. I'll see you next time. But until then, remember, stay marvelous.